So a hedge fund is just a large fund that gathers money from often private investors and institutions too. And they look for good businesses and invest in them like anyone would, hoping that the business profits and the stock goes up. But they also look for what they see as bad businesses that are possibly going to fail because of competition, bad management, or just bad economic prospects. And they find ways to bet with products that will increase in value when the business fails. Basically, with low interest rates, mortgages started to be extended to a lot of people that couldn't afford housing. And these hedge funds started to look at the market and say, not only is the housing overvalued, but the mortgage products and the financial innovation that went behind extending these loans, a lot of it was pretty dodgy, and they found ways to take the other side of the trade. So when these products blew up, which was caused by housing starting to fall, they made huge amounts of money with the way they structured their trades. So the hedge fund investors that are studying on how to profit from a fall in Canadian housing, they looked at the fall that happened in America in 2008, and most of the markets around the world just tanked. But for some reason, in Canada, housing, and especially Vancouver, took a minor dip and then rocketed back up. So they're seeing Canadian housing, and especially Vancouver housing, as an anomaly that basically needs to correct, but the factor that will make it correct is still unknown. A wide range of industry analysts see a huge flow of money from mainland China basically being poured into Vancouver real estate and increasing prices. So the difference between Vancouver and Toronto, Calgary, and Montreal, as these investors see it, is just that huge demand coming from China might keep Vancouver's market elevated, even if the rest of Canadian markets fall because of a raise in interest rates.